Thank you. So welcome, everybody. I'm very happy to talk about my latest research with Stephen Penman and how this started. It started with me teaching financial statement analysis and then, applying this financial statement analysis in equity valuation. And then asking myself, what is the point of this GPON analysis? How does it connect with equity valuation? And this is, how it all starts, I guess. So let me take you through my concerns and how we try to address it with this paper. So, as we all know, investors need to value companies, and when they do that, they seek, the present value of future cash flows. Let's call them dividends, all right? But rather than dividends, using financial statement analysis, we are looking at, drivers of value creation, and we translate these values of drivers of value creation in terms of earnings and book values, in terms of accounting, right? So I rephrase the question now and ask myself, so investors need to find information about future return on investment and risk. And what we know so far is we use a GPON analysis, right, to identify the drivers of value creation and risk. And when it comes to a GPON analysis, we can think about a GPON decomposition of ROE into two components, the return on invested capital and a financial leverage component. The risk from the financial leverage component to ROE is pretty obvious, I would say, and is quite deterministic. So it's all about the spread here, the ROA spread. So if this spread between the ROA and the net borrowing rate is positive, then that increases the ROE and vice versa. There is nothing really new about that or something to really think about it because borrowing rates and debt, it's all on the financial statements. Now, what about the ROA, the return on invested capital, return on net operating assets? If there is something to be discovered here is within the RNOA. So let us move to the RNOA and what GPON does to RNOA. So what we know so far is decomposing the return on invested capital into an operating profit margin and an asset turnover component. That's the traditional GPON analysis, and it works. Okay, based on previous research, we understand that this decomposition is very useful in predicting future RNOA, future return on invested capital. It works. But when you try really to put this structured information into market prices and risk, it's not working. I mean, you get all kind of crazy results. And why? First of all, the market possibly doesn't understand, accounting. And that's fair comment. Okay. But what about that the structure itself is not very conducive to tell us about risk? That is the question we want to really revisit. And how we are going to do that? Based on accounting principles. We go back to the basics. And I think this is a very good seminar, a very good topic for the accounting design project, because now we are talking about rules and principles underlying the generation of accounting numbers, bad accounting and good accounting. Now I'm going to talk about how these rules can really tell us something very, very practical about how to forecast and forecast risk. So this is not really new, okay? So we have first of all, the realization principle. What is the realization principle? I mean, a realization principle underlies the standard for the revenue recognition, for example. Okay, so we cannot recognize revenue if the contract is not complete and the receipt of future cash is very, very certain. Okay, So that is the realization principle. And what it says is that, future revenues, not realized revenues, and the earnings from these revenues are at risk. The second principle, which is very useful, is conservatism. And I'm referring to unconditional conservatism. And this is about the expensing of very risky investments. If the investment has very uncertain payoffs, then we don't really put it on the balance sheet. It's becoming part of the income statement as an expense. So that we have two basic principles here. And how they can be used, well, we have already some very strong basis for using that in the DuPont analysis. First of all, we have Penman and Zhang in 2020 who demonstrate analytically how these two principles determine the discount rate. That's okay in an asset pricing context. But the second also paper, Penman and Zhang 2019, provide empirical evidence to this claim. So armed with these two, we can proceed and think about the financial statement analysis and introducing these two principles into the decomposition, the DuPont decomposition. The first thing we are going to do is to look at operating expenses. Okay, and we're going to really decompose these operating expenses to two categories. We have expenses that generate, current sales that are very well associated with the generation of current revenues. And we have expenses that are really our investments into future revenues and future earnings. And we are going to introduce this disaggregation into the framework here. So the first line disaggregates these two types of expenses. So we have on one hand the MAT profit, that is revenues minus these expenses that generate current sales. Okay, so that will give us MAT profit divided by sales. Let's call it MAT profit margin. The second term is mismatch expenses to sales. And we like this very much because it tells us about the level of investments, these risky investments in relation to currently realized revenues. So it gives us a sense of the risk taking here. Now, let's try another step and introduce a multiplier. So we start again with MAT profit margin, but the second term now is something that looks like operating leverage. It's not operating leverage. I mean, operating leverage, proportion of variable and fixed costs. Okay, now we don't have this. What we have here is mismatch expenses against MAT profit. It looks like operating leverage, but it's in fact, it's a multiplier that indicates risk. And we have a third term, of course, the income not from sales. Now, what is this? It aggregates all these other items that have nothing to do with the generation of sales. That could be impairments, realized gains, unrealized gains and losses, and extraordinary items, almost everything in this. Why we separate them? Because in expectations, we believe that they are zero mean. Okay. Except one item, perhaps, the income from associates. That is not necessarily zero mean. So we don't really include this item in these categories, this third category. So when it comes to the expectation of operating profit margin, we have these two terms, the MAT profit margin and the multiplier. We believe, and that is to be tested, of course, that the first term, the MAT profit margin, is guided by the realization principle. And we think that, a higher magnitude of this margin suggests a greater extent of a risk resolution in line with the realization principle, okay? MAT profit indicates the ability to realize earnings from current sales. That's about it. Now, what is of interest here is as well is the second term, the multiplier. And as I say, we claim that it catches risk. But how? Here it is. So consider, a theoretical level A, the steady state condition for mismatched expenses, mismatched investments such as R&D. So a steady level R&D. Okay. Now, when the company is in a steady state, even this so-called mismatched expense is no longer a mismatched expense. It actually has the nature of a matched expense. And then, in this very theoretical state, there is no risk here. I mean, this ratio does not indicate any risk. Here is the thing, though, that levels higher than this hypothetical A, that is also corresponds to low levels of this multiplier, indicate growth in mismatched investment, which is captured by these mismatched expenses. Okay, so that's one. Conversely, a high level of this multiplier captures low risk in the sense that you have a decline in investment in this mismatched investment. So that is, I think we have a question here from Ayung, and I'm happy to take it.
Is it a good time?
Yes.
You feel okay. So I have two questions. One
Yes.
is related to your first component. When you apply the realization principle, I wonder, have you and your co-author thought about there are also estimates in sales revenues and estimates in the matched profit. So,
Sure.
for example, the new revenue recognition standard requires firms to estimate revenue related to variable considerations. So those are the situations when the uncertainty have not yet completely resolved, and then firms still need to come up with estimates, right? Estimated sales return as well. And for matched expenses, there are also estimates based on future unresolved
Yes.
contingent events. So how does that actually relate to the realization principles, and why those estimates would still be considered as a lower risk?
Yeah, I mean, certainly, in the very, very broad and wide framework that we discuss here, you could have all kind of refinements. So what you described now is an excellent, opportunity to do further refinements and accommodate, as you say, these estimates in revenue recognition, sales returns, rebates, and so on. So yes, I mean, as I say, this is like a towards a new financial statement. This is far from complete and accommodate not only what you say, but also it could accommodate the a number of other things. I mean, even impairments, which now we dismiss, they don't need to be dismissed in financial statement analysis about risk, because impairments, for example, could really denote a resolution of risk. It's done. The bad news have resolved and it's done. So there are, I mean, as you say, very useful, but I mean, as I say, fantastic ideas for extension and refinements. Okay. Second question.
So the second question related to the right-hand side of your graph.
Yes.
So I noticed that you and your co-author carefully articulated as a mismatched expenses, but I wonder, other than R&D expense, is there any mismatched expenses will be considered here?
Yes.
Because it seems like conservatism principle and then the higher risk are all kind of related to the underlying R&D expenses. So I wonder whether mismatched expenses here simply you are just referring to R&D expenses. So potentially you can give us a few examples about other line items also are mismatched.
Beautiful. Thank you so much. So, I mean, certainly, I mentioned R&D in haste, and I mean, I think that was not very fair to the paper because, what we do here, we consider a broad class of mismatched expenses. And we're talking about advertisement, of course. We're talking about SG&A. Now, when it comes to SG&A, this is a very difficult problem that frustrates us a lot, and I think frustrates most investors as well, in the sense that SG&A could include expenses for, training, for example, or other, selling, marketing expenses that may or may not be associated with the generation of current sales or future sales. And if they do, now there is not just the timing, but it's also the uncertainty dimension that, even, we offer training to our employees, then is it going to be successful or not? We don't know exactly about the future buyout. So, and we try to capture that using a very, very crude, 1/3 of SG&A. I know it's crude in empirical terms, okay? Hopefully there will be more refinements, but at the moment, the current state of disclosure of future-oriented expenses is lacking. And that's something that, when it comes to accounting design project, is something that, could be improved with better disclosure, because I think this is an important part in defining the risk important to our framework. So that's why I think, this was really a very important clarification that I think I missed in my haste. Thank you.
Ken, you've got a question.
Yes, thank you. This is an interesting area, Christina, so I certainly appreciate reading a paper of this kind in these days.
Thank you. Ken, I think you're frozen.
Can I? I'm sorry to come in. I can't find my, raise your arm button. Sorry.
Okay.
I know it's a continuation of that last question, and you know me, Christina. I'm not remotely as robust as you are on the
you talk about
theory.
matched profit.
Mine comes from equity analysis experience, and this is a typical question of a hard bit node analyst who never believes a single word that a company ever publishes. Because you're always skeptical. How do you actually get companies to disclose the division between what I would call sort of mainstream continuing profit, and the mismatch is basically, as you say, R&D, but it could, as you're right, it could be money spent on employing a bunch of people to try to design a new game. There's not actually R&D; it's just salaries on a new box design. How do you manage to get companies honestly to differentiate between conventional mainstream SG&A designed to generate revenue that year and marketing or development or sort of just staff expenses designed to try and develop a future program or a future
I mean, okay, we are kind of deviating from the topic, but, I think it's a very good question, that is really getting on in my mind these days with some other projects. So, I mean, it's all about, it's not, I mean, currently we don't have this disclosure. We assume, okay, big problem. But, there is currently a lot of discussion among accounting standard setters about providing more disclosure, not necessarily quantitative, but also qualitative disclosure that allows the investors to really understand where we stand with these topics. So this is, I mean, I'm glad to take this discussion with you in Exeter, because we do a lot of, I mean, I'm working on these issues as well. I think it's fascinating. Thank you.
Ken, I think you're back with us. Do you want to try asking your question again?
Yes, please.
Maybe Ken's not back, so maybe Christina, if you continue, and Ken, if you are back, if you just raise your hand.
Or Ken, you can write your question on the chat and then I will try to pick it up. All right. So continuing from this. So with these two considerations, our final, resolution is this formulation that you see in front of you. RNOA equals, match profit margin multiplied by asset turnover multiplied by what we call the mismatch expenses multiplier. Now you can ask me why asset turnover is in the middle. Okay, and that's something we have been struggling for a while. Oh, wow, because we think that the interpretation of the role of asset turnover is contextual with the both, the two ratios on the left and the right-hand side. I'm going to give you an example, okay, to really give you an idea about the role of asset turnover. So you may have, a mature pharmaceuticals company with, a large extent of the risk resolved at this point that will give us high max profit margin, high asset turnover, most likely, okay. But then, is it that the risk is resolved and we have safe outcomes or not? Nobody knows, actually. And we need to really, first of all, consider that the asset turnover has a denominator, which is net operating assets, that may not include, expense investments. So the sales, the future sales out of this ratio could be at risk for this reason. But what really determines risk, as I say, is the third term, the mismatched expenses multiplier. So with in this setting, with this pharmaceutical firm, that is, asset turnover may suggest risk resolution, but with a very high, very low actually multiplier here and high risk, things can be completely changed. So, and this is something that we also see in the numbers later on in the empirical investigation. So, I mean, let's call it a term that is interpreted contextually with reference to the other two terms. And the good position for this term will be in the middle. So that is what we come up with. And what comes next is testing this with respect to payoffs.
Sorry, Christina. I think Ken's
could
back.
I have
I
a
think that's
second
point
try
to
here
jump in.
at asking you the question? The RNOA that you calculate here, is that the observable RNOA from the financial statements?
Yeah.
Or is it only with, I mean, what is your concept of a matched profit? Because what you calculate here in your leverage quotation mark ratio, that is the difference between the matched profit and the mismatched expenses. So is the idea really that you want to take out mismatched expenses from matched profit? Isn't the idea that you want to take out the mismatched expenses from the reported profit? I'm sorry, I haven't read your paper carefully.
I see.
So I just wanted to clarify, if you could clarify that. Thank you.
Yes, please. Yes, yeah. Okay, let me go back to this. Okay, so I mean, our basis, I mean, at least in the empirical implementations, is reported numbers. Okay, but the concept is that in the max profit, we have sort of, what to say, I mean, it's operating profit minus, I mean, and we add back the mismatched expenses. I don't know if that helps. So max profit is operating profit, adding back what we think are mismatched expenses. Does it help? It's adding back.
Okay, you have a minus sign here on the mismatched expenses, so you add them back. Then,
Yeah,
then,
max
then I
profit.
follow.
Yes, max profit
Yeah, good.
is,
Thanks.
yes, okay.
Okay.
So I'm talking about payoffs now, okay? I mean, how to test, whether, this formulation, this information construct that we propose can predict future outcomes and future risk. So talking about future outcomes, we go back to valuation theory, and we are looking at operating income and, and residual income. Okay, so the first line is really a rephrasement, restatement of the residual income at the enterprise, level. And the second line is really equivalent to the first line, although it's a bit bizarre how we end up from the first line to the second line, but I can assure you, yes, the mathematics are there, correct. And the good thing about the second line, it gives us an opportunity to think about value in terms of the sum of future operating profit. And then, of course, that gives us an opportunity to decompose the future operating profit to future max profit and sum of future mismatch expenses. And there is another term, that's the sum of future free cash flow reinvested. So when it comes to payoffs, we don't really think about future mismatch expenses. That is not really a payoff. The payoff we think about right now is the future match profit, and the future match profit with reinvested future cash flows. I mean, these are, let's put it like that. The second is a narrower, definition of the first most correct definition of future payoffs. Now, what we do with these payoffs? I mean, we explore the payoffs in the horizon of the next 1, 2, 3, and 4 years. So the result that we present here is a horizon of 4 years ahead. And we also look at the dispersion of these outcomes as an indication of investment risk to begin with. Okay, so the data are US GAAP data from 1995 to 2017. Standard, exclusions of financial firms and utilities and stock returns. We are looking at future stock returns, future, 3 years ahead after the fiscal year end of each year that we examine. Now, going back to the Ken's question, how do I define match profit? This is operating profit, and back the mismatch expense, and of course we adjust for these impairments, realized gains and losses, and so on. Okay, except for the income from associates. Yep, Adrian.
Sorry, just to go back to a few slides you've got in here, and I think this is one of the key parts of the paper in terms of considering risk of future earnings. And it looks like what you've done is included the term and discount rate term to capture risk in the numerator here. Now, okay, if that risk term is essentially based on it's the same as the denominator, i.e. The risk for equity investors, is that going to be the same concept or the same approximation of risk in future earnings? So essentially, the question comes down to, are you looking at risk based on an equity valuation, or are you supposed to be here determining risk based on some sort of expectation around future earnings? So essentially, is the key point here that you're determining an accounting risk term or an earnings risk term? And so in terms of that, it should be based around, so my way of thinking would be in terms of, instead of the covariance of the market returns to firm returns, is it supposed to be a covariance of market earnings to idiosyncratic earnings divided by this expectation of idiosyncratic earnings?
Yeah. Okay. This is kind of my decision to really, talk about, an important part of the paper, which I find, a bit distracting, but, I'm not right. I think I should really talk about the Littner ratio. Okay. And in the paper, we demonstrate that what defines risk, I mean, irrespectively of whether it comes from accounting outcomes or any other outcome, it's about, the covariance of future payoffs, whatever, you decide is future payoffs with the market, okay, divided by, scaled by the magnitude of these payoffs. So this is, something that I don't really have it here. And thank you very much for suggesting that. So what I'm talking about covariances. Okay, so to talk about covariances, first we have to understand, the source of the variance in these future payoffs, and then, as a second step, we are going to see how these covary one way or the other. So we run this test as well. I mean, so if you ask me, yes, covariances is the base of the risk, and the covariance comes from the properties of the fundamentals, because the properties of the fundamental will tell us about the variance in the outcomes, the payoffs, and then, of course, a empirical question: do they covary with the market? If they do, yes, there is systematic risk there.
Ayun.
Hello, Christina. I have a similar question to what Andrew just raised. So let me clarify it. So like I think the R here, which is the discount rate, and then traditionally we thought about that as capturing risk of the firm. Is that in your model a constant value, or is that contingent on how much mismatched expenses a firm has? Because here from the equation, we don't see the R here actually is somehow stochastic and contingent on mismatch expenses, which is what you talk about on the earlier slide, that the more mismatch expenses will reveal more risks, right? And then that's why those mismatch expenses somehow are very relevant, telling us. So I just want to clarify whether the R here is a constant term or is actually contingent on some of the parameters you have in the equation. Yeah.
Okay. So, I mean, defining the payoffs in this empirical setting. Okay. So I'm talking about empirical implementation. I mean, there is an R in the first, category in the first definition. And this R is taken to be a risk-free in the empirical implementation now. Okay. That's why, because I don't really entirely trust this. I mean, I'm very much, looking at the second classification, the future mass profitability, which doesn't really involve any risk assumption, any R assumption here. So I think, the future mass profit alone can tell us a lot of things, a lot of information about the future, the investment risk. So, I mean, okay, I offer both, we offer both, situations here in terms, of empirical examination. But, with, of course, the disclaimer that actually, we could, I mean, it's, they are here, in the first definition could really take some improvement. I mean, as I say, it's not perfect, but I think especially the second definition can tell us a lot of news about how this mismatching will really give more risk, tell us about risk. So I wouldn't really get hung up into this R in this first definition, to be honest. I mean, I would say, well, I'm just offering that for the sake of completeness, but the R that we are trying really to identify is by means of the dispersion. Okay, I mean, let's really see if there is risk. So if you don't mind, I would like to proceed to show you some results, and we can really think about that again, please. Yeah. So I was saying that, we have, the very, very, very basic definition of max profit as operating income, adding back the mismatch expenses. Now, when it comes to mismatch expenses, I would like to clarify that in terms of empirical implementation, we have R&D, advertising, and 1/3 of SG&A. And we have also, another category of quasi-match expenses. So what are these? Advertising and 1/3 of SG&A. I mean, this is, we understand that there are different levels of mismatch in between R&D and the other category of expenses. So we would like really to see if, this will appear in our data investigation and our tests. So the distribution of the variables, I mean, one thing that you may note is RNOA to begin with, and median value of around 14.3%. This is a bit high. Why it's high? Because it's before tax. Okay. So, I mean, usually we refer to RNOA after tax. Now this is before tax. The mean is very low. Well, obviously, due to the effect of mismatched expenses, that's something that we see very much, especially after 2000. So that I would like to comment. Now, next, what we have here, and I find, quite fascinating, exploring the drivers of the Gibbon analysis, is how and whether, its driver affects the pattern of RNA across the time. So RNA, declines after, the 80s. We have, relatively low RNA, and that is, that is not really due to the effect of match profit margin. I mean, what is quite surprising, match profit margin really gets quite high in years after, in the 2000 and after that. And I think, to understand what happened is to look also at the mismatch multiplier. It is actually the mismatch multiplier that really drives down the RNA as expected, okay? But taking these two together, you understand that, all these mismatch expense at the end of the day, they have an outcome, they have a positive outcome eventually, I believe. I mean, but that's something that we need to test separately. And that is, we see an initial, understanding of the relation between mismatch investments and future profit margins, match profit margins. So that's something I would like to say. Asset turnover, matters very much the pattern of RNA, and perhaps in the latest, few years, we do have a very, very low values, possibly because I have included negative asset turnover in this graph, and that really makes, it makes this trend very, very low. When it comes to the correlations between, the variables, the RNA and its drivers, we understand that, a big driver of RNA is the mismatching multiplier. And what is, I think, is also of interest is the relationship between the match profit margin and the mismatch expenses. And as you can see here, it's, it's about 30%. When it comes to, there are two types of correlation, the Pearson correlation here. So we do have this notion of, mismatch expenses, being associated with future profitability. So, and again, we need to test that. So how we test that? We run two types of tests. The first category is using portfolios, and the second category using regressions. Now, let me talk a little bit about the portfolio structure. So we're talking about a nested sorting. What I mean by that? Here I have level 2, but what is level 2? Okay, we begin with the classification of observations along the magnitude of match profit margin. That's level 1, which is not really depicted here. So we have the 30% low profit margin as one portfolio, and then the between 30% and 70% medium match profit margin, and 70% and above it's high match profit margin. So this is the first level of portfolio construction. The second level of portfolio construction is to really do again split the each match profit portfolio into 3 asset turnover portfolios. So within each match profit margin portfolio, we have the very lower than 30% cutoff, and higher than 70% cutoff point in asset turnover portfolios. So we have, as I say, a nested sorting. So that is, the first level. And then we introduce the third, dimension in exactly the same process for each asset turnover match profit portfolio. We divide this, we take the distribution of observations, and we really split between high and low mismatching. Now, I call it mismatching but what is really is the magnitude of the, the mismatch expenses multiplier in the opposite way. And I explain. So the portfolio 111 has very, obviously a very low match profit margin. And, within this low margin, it has the lowest asset turnover observations. Now, on the third level, portfolio construction, this has also a very high mismatch expense multiplier. But as I say, high mismatch expenses multiplier is low risk. Okay, so 111 has this low level, but it has low risk. On the other hand, the portfolio 113, that is on the third block down. Okay, that's the first portfolio on the third block. 113 has again low match profit margin, low asset turnover, just like the 11, the first one. The only difference now is that this has a very low mismatch, mismatch expense multiplier, which in our interpretation denotes high risk. Okay, so the test that we take is really the following. We compare the 113, for example, with 111. Okay, so we try to establish the effect of mismatching, holding constant match profit margin and asset turnover. And if what we think about the effect of conservatism and unconditional conservatism, it should really appear in this comparison. That would be on one hand, we expect that this will produce, future outcomes, that mismatch expenses are connected with future match profits. There is a positive association, so we should really see graded larger payoffs, but also that will be a positive sign in these comparisons, but also these payoffs come with a lot of risk. So there will be also a positive outcome in this comparison. So that's the main prediction for this test. And this is, okay, I think there is a question. Joshua?
Yeah, so with your classification, are you not going to get industry concentrations in certain cells?
Yes, we could. Yes, actually, I did that. But we believe that what we call industry, classifications and concentrations, these notions capture the mechanics that we describe at the end of the day. So you can call it industry concentration or industry, you have all the technology firms in high mismatching, and you have all the truck drivers, on the first, trucks and transportation, on the low mismatching. Yes, we do that. But ultimately, what we think is industry classification is mechanics underlying this. So that's.
No, but that would affect your portfolio balance, right?
It is to some extent, but it's really a perspective, a question of perspective. Future is future. I did something like, when we run the regressions, I tested for industry effects. Okay, it's in case. I don't think, they were, if I remember well, they were not really strong. Because the underlying mechanics and the accounting principles can tell us more information than any industry classification. But it's really, a very nice point that, we could really explore, or it could be explored in another paper. But you're right.
One suggestion is to do the same analysis within a sector or within an industry. And then you actually compare apples and apples. Just suggestion.
Yes, but the thing is, why I'm skeptical about this is it's not just the industry. Then you have to really think about life cycle. Okay, So, younger, pharmaceuticals and more mature pharmaceuticals are not the same. They're very, very different species. So, I mean, you can really think about, even when you talk about industry classifications, there are different ways of really classifying industries. You could be based on SIC codes, or could be based on the disclosure, like the Homberg and Phillips classification. So, I mean, it could be a million ways to talk about the very same thing, the principles behind this, what we perceive as industries. So, as I say, point of view and perspective, but definitely that's something that I spent some time thinking about that. So, but you were right, but it's a matter of perspective from my opinion, at least.
Thank you.
Thank you as well.
Ayul?
Hello, Christina.
Yes.
So the other way to think about industry is you actually have a industry irrelevant way to identify mismatched expenses. But in reality, we all know that probably pharmaceutical firms' SG&A has a lot more mismatched expenses compared to a construction or truck driving transportation industry, right? So one way it's kind of like it goes into a circular situation, because what you want to pick it up is actually industries that have a lot of mismatched expenditure exposed, but ex ante, you actually do not have an industry specific measurement for mismatched expense. So in the chat box, I shared an article recently published in Management Science, but Sean Wen also presented his paper probably 5 years ago using the purchase price allocation from M&A consummated deals to try to estimate parameters more related to industry specific transactions and nature of the business models. So that potentially can refine your mismatch measure. Yep.
I mean, one thing, that you can, I mean, it's difficult to perceive, but I hope I will try to clarify. I mean, the Magnificent Seven, you see Amazon or Google, and you think that, they have high mismatching. Actually, they don't, if I remember well. Maybe, I think so. I mean, it's all, relative, they have very big match profit, but, it's a relation between the mismatch expenses and the match profit. So as I say, it all breaks down to the primitive variables rather than call it somewhere, but I will certainly, that's something that we need to really explain better with Stephen, why we think that industries may not really matter. And it's all what we call industries characteristics. It's matter of principles and, relationship between accounting numbers. It's not about industries per se. But definitely, thank you so much.
Yeah, I think all of that. Yeah.
Carry on, Ayul.
Oh, okay. I think you can move on. I think given the time we have. Yeah.
Thanks.
So I think Jane had a question too. Jamie, are you trying to raise your hand? You're on mute.
Yeah, sorry, I unmuted. But no, I'm just going to wonder whether, sorry, slightly probably repeating what just been said. Can you demonstrate ex post with historic stats differences in connections between mismatched expenses and latest performance between sectors? For example, you mentioned Amazon, and you say how now they don't seem to have a lot of mismatched expenses. Go back 20 years and they must have had a lot, because all of Amazon's expense 20 years ago was being spent to create future profits. Can one rebuild that up ex post, or is it too difficult?
Yeah. I mean, I cannot really do it, but I can show you some statistics that, are in the paper, and maybe that will, help you a little bit.
Yeah.
So what I'm going to show you now is, particularly, I mean, if you have doubts about, the match profit plus reinvested free cash flow, then you can really think about future match profit margin divided by current NOA. And then we think, we find that, the formulation, the structure predicts future, outcomes. Okay. So we do have some first hand evidence. Now, introducing, the mismatching leads to even, higher outcomes. And as we predict, the effect of mismatching has a positive effect in the sense that, higher mismatching, higher expected profitability. Okay, simple as that. But when we repeat this exercise with a regression, and again, the coefficients are positive, with the more prominent coefficients being the mismatched expenses. Now, talking about risk, and this is where things are getting a bit interesting. So we start with, the match profit margin and asset turnover, delineation, and then adding mismatching tell us that, increases the variation in future outcomes. So that's the second line. From the 1142, we jump to 5.096. Is really the effect of mismatching in denoting higher variation in future outcomes. And we observe that this increase in variation in dispersion, and this is interdesired range dispersion, is quite, across all the portfolios that we examine. Interestingly, and I think that's a nice result, I mean, we see on the first line of, the low asset turnover line, that, this has a negative trend, which we like a lot. I mean, why we like it? Because the low match profit margin, low asset turnover are traditional low realization portfolios. So there is a lot of unresolved risk. Adding more mismatching to this make them highly, dangerous risk portfolios. But as match profit margin increases, then, more risk is resolved. So, I mean, adding mismatching could have, a very, very different effect there. So that is, one possible, nice outcome of this. I'm also, very much, intrigued by, the high asset turnover together with asset, high mismatching, which, gets me back to what I told you earlier, that also asset turnover is interpreted together with mismatching. So you have a combination of this. This means high risk. So that is repeated with interquartile range statistics. And then we are looking at, risk other tails, courtesies. I would like to drive your attention to, the right-hand side of these courtesies, which I call, upside risk, upside potential. And the statistics are very much similar to what you have observed with dispersion, with same patterns. Interestingly, if we look at the left-hand side potential, the downside risk, there is nothing much there. But remember, these outcomes are future earnings for year ahead. And we have lots of observations in this region that are dropping for our tests. Why they're dropping? They're delisted for bad performance. And we do have statistics for this. So I'm not, yes.
At this point, we've got a couple of questions. So Noah?
Yes. I don't mind. I mean, could you please, can we really take these questions after? Because I would like really to show a few more results and we don't really have much time, please. Would that be rude?
Maybe if we take the two questions now and then continue on uninterrupted till the end.
Yes, because we just have 5 minutes. Okay, so if I can have 5 minutes uninterrupted and then take the questions, please. Thank you so much. So what I was talking, we also have results from skewness, but skewness is about these central, observations. So, what we understand is that mismatching, taking place mostly at the tails is really a matter of risk at the tail risk. So regressions actually confirm this. What I would like to show you is some first results, by talking about covariances. Okay, ultimately it's about covariances. So we do have, evidence about the dispersion of outcomes. Now, do they covary? And what the market tells us. So we have some loose evidence from predicting future returns. What I would like to show you is that actually this structure of information is very good in predicting future betas. Okay, so we run, the portfolios. We have the portfolio delineation information, and then we observe, the betas 1 year ahead. Okay, and mismatching not only, give us higher betas, and give us higher betas across almost all portfolios. So I think this is a quite strong result, and we confirm this using earning betas as well. Okay, same pattern. Adding mismatching increases betas, and it does so across almost all portfolios, and particularly, these portfolios with high asset turnover. So mismatching high asset turnover really gives you high risk. And this is a result that we see across all our tests. And so I think with, we also really run regressions as well. And the prominent coefficients again is the mismatched expenses. We also have further results with regressions. Now the variables are denominated by enterprise value. Why we do that? You can think about future, you can think about that as earnings multiples. We introduce a discount notion in these fundamentals. And if you do that, then, these variables are getting even better in predicting future returns. Now, delisting due to bad performance. This is what I just told you earlier is, our formulation, our information structure is also very good in predicting delisting due to bad performance. So what we have as risky outcomes in terms of realization principle, low match profit margin and low auto have very high chances of getting delisted for bad performance next year. The opposite, of course, happens with a high match profit margin. And, oops, sorry about that. No, that's page up. So, and that the same, I think, yes, oops. I think, that also, increases with mismatching. And I think I completely what I wanted to say. I think both, the dispersion in fundamentals and also the covariance test, the market test that we conduct, demonstrate overall that adding mismatching in the DuPont analysis adds information, and mostly it's about information about risk. So with this, I would like to present the next accounting project seminar, which is by Srinivas Mahapatra. And the paper is about decomposing first revenue into price and quantity, which I think will be very interesting. So yes, with 2 minutes to go, I'm very happy to answer any questions, and I'm here to really have a further conversation later on. Thank you.